Hi there. In this video, we're going to be looking at finance as a management process. Firstly, what is accounting? Now, this is the managerial and administrative tool that records financial transactions so that business money may be traced. So in a nutshell, where is the money coming from? Where is it going to? Who is it going to? And in what financial state is the business currently in because of that inflow and outflow? Now, there are three types of financial statements. We've got a cash flow statement. Now, this shows the movement of cash receipts or inflows, such as money from sales and cash payments. Now, cash flow statement is very important for showing liquidity, which is the ability for a business to meet its short-term financial obligations, and it's really important also for showing the cash flow in the business to make sure that they can meet their short-term debts. The second financial statement is an income statement. This is a summary of the income earned and the expenses incurred over a period of time, ultimately showing a profit or loss for the business. Now, over a period of time could mean every quarter, so every 3 months, or it could be every financial year. So it's important that when looking at an income statement, you look at the title on the top of it, because that will tell you the period of time that the statement is referring to. And the third and final financial statement used is a balance sheet. Now, this shows the value of assets, so what is owned by the business, liabilities, what is owed by the business, and owner's equity at a point in time. Again, normally a calendar year. So, looking a bit more in depth at income statements, there are 5 main elements of an income statement. The first being revenue or income, so money coming in, and this is derived from net sales. So, very basically, how much money is coming into the business based on selling products. The second element is the cost of goods sold, also known as COGS. Now, this is the value of stock that a business has sold to its customers. So, what COGS is basically the money spent to buy a product, and then you then on-sell to a customer, really. So how they calculate this is opening stock, so how much you start with, plus purchases, so how much more do you add to it, minus closing stock, so minus what you're left with after you sell them. So the best way to explain cost of goods sold, or COGS, would be a retail store. So they purchase, televisions from a manufacturer that cost $1 million, and then they sell them onto consumers. So you're looking at how much did you pay to buy the stock, and then how much are you left with at the end. Okay, so how much did it cost for you to actually have something to sell to your customers? The third element is gross profit. Now, this is calculated by sales minus your cost of goods sold. So if you sold, or if you made $2 million worth of sales, but it cost you $1 million to buy the stock to sell to customers, then gross profit would equal $1 million, because it cost you that $1 million to actually buy things to sell in the first place. So 2 million minus 1 million equals 1 million. The fourth element is expenses. These are simply costs: insurance, wages, utilities, electricity, gas, water. That's those sorts of expenses. And your net profit, so what you're left with finally at the end, is your gross profit minus your expenses. So once you've worked out how much you've sold, how much it cost you to make those sales, then you get rid of all your expenses. Whatever you're left with at the end is the net profit. Okay, that's how much the business has made. And then they'll be paying taxes on their profit later on. We've got balance sheets. Now, as I said, this shows assets, items of value, so what the business owns. And there's two types of assets. There's current assets, and they're things that can be sold or turned over within 12 months. Anything that is above 12 months or is, within 3 to 5 years is a non-current asset. So examples of the two, a current asset may be cash. So they might actually have cash on hand. They can, go to the bank. They can buy things with it. They can turn it over within 12 months. A non-current asset might be vehicles. It might be very hard to sell machinery or vehicles or equipment. So while it's something of value, it may take a little bit longer to sell. So it's classed as a non-current asset. We've also got liabilities. These are items of debt, so things that the business owes. And just like in assets, there are both current liabilities and non-current liabilities. Current liabilities are repaid within 12 months. They're very short loans. An example may be a bank overdraft. They pay those back normally after a couple of months. A non-current liability can last up to 30 years, so this is more likely to be a mortgage. And then we've got owner's equity on a balance sheet. These are the funds contributed by the owners of the business. It's also referred to as capital. Now, when you put these all together in a balance sheet, as the name implies, a balance sheet must balance. If it doesn't balance, then it means that something a little bit strange is going on either with the accounting or the business itself, but it must balance. Now, there is an equation. The best way to remember it is aloe, just like aloe vera. Aloe. A equals L plus OE. Or in other words, assets equals liabilities plus owner's equity. So for example, if you've got $1 million of liabilities that you owe, and the owners have put in $1 million of their own money, that means you must have $2 million of assets, things of value, in your business in order to offset the debt. Now, the reason for owner's equity being classed with liabilities is because eventually owners want a return on their investment. They want to receive their money back. So it's not seen as an item of value. If anything, it's a liability because if an owner decides to leave, they may want to collect on their investment. So the business needs to find an asset, something of value, in order to pay it. So assets must equal liabilities plus owner's equity, must balance. So I really hope this brief introduction to finance as a management process has given you a better understanding on what is accounting and the different types of financial statements. Thank you.